You see all these buildings behind me? This is the #1 secret to wealth preservation and appreciation that is laying right under our noses. And many people think we don't make enough money to own that, and that may be true. You may not make enough money to own it directly, but you can actually own it indirectly, because there are a lot of funds that will allow you to invest at a small barrier to entry. And why is real estate one of the biggest wealth appreciating tools available? So real estate is a great inflation hedge. What does that mean? As the value of the dollar decreases and inflation increases, the steady factor, which is a favorable variable here, is real estate, because the price is going to go up relative to the rise of inflation. And when you park your money into an appreciating asset, which real estate is, you're able to preserve your wealth at the same rate. Comparatively, if you were to just put your money into a bank account, it would just sit there. And even if it's earning a decent amount of interest, you're still not going to earn the amount of interest that's equal to the inflationary rate, meaning your money is continuously devaluing and making you, in essence, less and less wealthy. What do the big guys know that we don't? They know that this is a great tool, not just from a wealth appreciation perspective, but also from a tax perspective, because the tax code loves real estate investors. Let's talk about that for a little bit. Why does the tax code love real estate investors? Well, first of all, let's talk a little bit about what you can do as a real estate investor. You have huge tax code benefits, such as depreciation deductions, accelerated depreciation deductions through cost segregation. You have real estate professional status, whereas your real estate losses can actually offset your ordinary income, which does not happen to everyday investors. But most importantly, you have tax-free, in some instances, cash flow positive operations. The government loves real estate developers because this is something that the government isn't going to do. They're not going to build housing. They're not going to build infrastructure. They're not going to build hospitals. They're not going to build schools. They're going to contract that out to private citizens who are then going to use their hard-earned money or raise investment from other people's hard-earned money to build all of those things that I just spoke about. And because they're taking on that risk, the government says, well, thank you for doing a service for everybody here. This is something that we need to get done, but we're not going to do it. You're going to do it. And for that, you are going to get rewarded. Because you have to keep in mind, at the end of the day, our tax system in the United States is an incentive system. The government steers you in the direction that they need to go in. Case in point, solar credits. Recently, solar energy credits have been through the roof. If you install solar in your home, you get a 30% tax credit. If you buy an EV, you get a huge tax credit, up to $7,500. The government isn't just giving this out because they have deep pockets. They're doing this to incentivize people to adapt the certain technology that they want you to adapt, just as they do with real estate development. They want more housing, especially in a specific location. They're going to incentivize that. And we're not just talking about on the federal level. We're also talking about the state level. And they give incentives also on the state level. For example, real estate tax abatements. They'll give developers a real estate tax abatement, meaning they won't have to pay real estate taxes or just pay real estate taxes at a much lower rate. And I mean significantly lower rate than the current rate, because they're building a building at a certain location where that town or jurisdiction wants development to be done. This lasts for about 15 years. These are amazing incentives. Let's take this in the same direction and talk about qualified opportunity zones for a few seconds. This was huge about 6 or so years ago with the Tax Cuts and Jobs Act. You were able to invest in what was deemed a qualified opportunity zone, and as long as you made an investment and developed a property there, you were essentially allowed to transfer gain from another transaction that you have made into that qualified opportunity zone and defer the tax on that gain till December of 2026, which was a long time when it was first introduced. That's still available to you if you make an investment in a qualified opportunity zone. Not only do you still have a few years to defer that gain altogether, but if you keep your investment in that qualified opportunity zone for at least 10 years, the gain that you realize on the zone itself is not even subject to tax. Where else can you hear about this? That's an amazing opportunity to save a ton in taxes. Now, back to the real estate topic. As a developer, you're building buildings and you're getting all these amazing tax incentives. But one thing that we have to also understand is in order to be able to get the specific tax incentives that you see by being a real estate professional, you actually have to meet certain criteria in order to benefit from it. By being a real estate tax investor, we just said, you're able to offset your ordinary income with any passive losses that you recognize from your real estate activities. And there is a list of things that you have to meet a real estate professional. At the end of the day, there are a few things that you have to keep in mind if you're looking to achieve real estate professional status. And that's putting in 750 hours a year on that activity, being the one that's doing most of the work on that specific activity, as well as spending most of your time as a professional in real estate activities. If you're a tax advisor and also have a real estate development company, if you're doing most of your work in tax advisory, you may not reach that real estate professional status. There is a loophole here for short-term rentals that are kind of carved out of this entire real estate professional conversation. That is, short-term rentals are deemed ordinary income in the first place. You could actually get the benefit of all the things that we talk about with real estate professionals if you operate a short-term rental. And what the IRS deems a short-term rental is a property that you rent on average 7 days or less each year. What can you benefit from if you do have a short-term rental? You can benefit from depreciation losses in the year that you acquire the property. We usually combine this by recommending that you would do a cost segregation on that property to be able to carve out all the shorter life assets to be able to get huge bonus depreciation on that property that you place in service that year. Another favorable thing in the real estate industry that you don't much see anymore in other industries is the 1031 exchange. Now, that used to be open to business property, meaning you can actually trade in a car for a car, a boat for a boat, piece of equipment for another piece of equipment, and you can qualify as a 1031 exchange, meaning a tax-deferred exchange. But they eliminated that and now only allow it for real estate. What a 1031 exchange means is you're swapping like-kind property for other property. In this case, we're swapping real estate for other real estate. So if we have a building that we want to sell, maybe we want to get out of that location, or we're looking to buy something else, but we don't have enough capital, so we need to sell it. In order to do so, what we can do is sell property A and acquire property B. Property A probably has a huge gain built into it. Let's hypothetically say you bought it for $100,000, now you're selling it for $700,000. You have a $600,000 gain on property A. If you go ahead and dispose of that asset and buy property B, you're recognizing capital gains on $600,000. Considering their long-term capital gains, great. We can say, oh, that's only 20% plus 3.8% net investment income tax. Whether you're a real estate professional or not, we can discuss that as well. But that's not the only thing that you're subjecting yourself to when you sell rental property. You see, the depreciation that you've taken on that rental property is added back at a much higher rate. You're not just taxed at 20% of the gain, you're also taxed at the depreciation add back number that you have to go ahead and pay tax at generally your ordinary income tax rate. And that can hurt. What we can do instead is a 1031 exchange, where we're going to swap property A for property B. And essentially what we do is carry over the capital gains onto that new property. So if we're buying this new property for $1 million, we still have $600,000 of gain that we have to pay off of property B. Now, what we essentially did is tack on and shift that capital gain onto property B. So to kind of paint a picture for you here is, we can say we're paying $1 million for this property. That's going to be our basis. But when we turn around and sell this one, property B, assuming we're not going to do a second 1031 exchange, let's shave off the cost basis of $1 million by 600, and our new cost basis in this property is going to be $400,000. That's how I kind of look at it and explain it to clients where it makes sense. So when you go ahead and sell property B, let's say you sell it that same day or the next day, you're actually going to recognize that $600 gain, because you'll sell it for $1 million, but now your new cost basis is $400,000, which is the $600,000 that you converted from property A. That's another thing that you can do. You can utilize that 1031 exchange. And the question is, well, how long can I do that for? You can actually do it indefinitely. You can 1031 property A into property B, and then let's say 5 years later, you want to buy another asset, you need to dispose of property B. You can go ahead and push that gain onto property C. And the gain is not eliminated, it's just deferred until the last transaction, meaning when you sell that final property, that's when you're going to have to pay the capital gain for all the previous properties that you may have 1031 into that last property. There is one way to actually eliminate all the capital gains that you may eventually have to recognize from the 1031s, and that's the step up in basis upon death of the taxpayer. When the taxpayer who's been doing all these 1031 exchanges passes away, the basis of that property actually gets stepped up to fair market value. And if the value of that taxpayer's entire estate is less than 12 million and change, let's say 13 million for federal purposes, they actually don't have to pay tax at all. and you can get out of it that way. You also have to obviously consider state implications depending on where you live when you pass away. But all things considered, that may be one way of not just preserving, but continuously growing your wealth generationally. Because what happens to that property when you pass away? That transfers to your next of kin through an inheritance or whatever you deem in the trust or will, and they receive that asset at fair market value. So if they decide to turn around and sell that asset the next day, they can essentially pay 0% in capital gains tax. And considering the estate paid 0% in estate tax, this is a win-win across the board. And that, my friends, is how you preserve wealth in the real estate industry, and how you can actually get into it on the lower level by investing into funds. You can find a fund where you can become an investor. You can put in, depending on the investment itself. So you can invest into funds that invest in real estate and also get the benefits of all the appreciation. Maybe not necessarily the real estate professional status deductions, but you can get the appreciation, you can get the tax-free cash flow, and be able to preserve and grow your wealth for generations and generations. I know that was a lot of information. I hope you found it useful. Like, follow, and share, and I'll catch you next time.